So Aiden, today's episode is all about institutional trading, right? That's like trading from a school? Do they wear uniforms? Is there a bell? I'm picturing traders lining up for lunch and gossiping about earnings reports in the cafeteria.
Not quite, Claire. Institutional traders are the big players. Hedge funds, banks, and firms moving massive money. No bells, but definitely some high-stakes drama.
Oh, okay. So, not like a school. More like a shadowy financial dojo.
Honestly, that's not the worst way to put it.
This is why I love this podcast. Because I get to learn and make things weird. Check out the latest episode of Pit News on Air, where Jake and Lena show us how to track the big money traders using something called the Chaikin Money Flow. Sounds mysterious. Probably is.
It's not mysterious, Claire. It's math.
Same thing. So grab your coffee, your charts, and maybe a decoder ring. Because we're going full Wall Street today. Take it away, Jake and Lena.
Ever get that feeling, watching the stock market, that there's just more going on than what you see on the surface?
Oh, absolutely. Like the really big moves, the ones that actually shift prices significantly.
Exactly. It feels like they're being, orchestrated by players on a totally different scale.
You're definitely onto something there. We're talking about institutional traders. The entities with really deep pockets.
And our actions just ripple through everything.
Right.
So today we're going to try and pull back the curtain a bit on them.
Yeah, think of it like trying to understand deep ocean currents. You feel the surface waves, sure, but the real power, the big shifts, are driven by those massive forces underneath. Pension funds, hedge funds, big investment firms. Their trades are those currents.
And knowing which way they might be flowing,
Yeah.
that could be pretty valuable.
Incredibly valuable, yeah.
So that's our goal for this deep dive. We've got this really focused article here from the Stock Market Cheat Sheets newsletter. It's all about decoding what these big players are doing. Our mission really is to help you get the insight to see their influence. And maybe, just maybe, figure out if understanding their methods gives you a sharper edge.
And look, the goal isn't suddenly trading like a giant hedge fund, right?
Yeah.
That's not realistic for most people.
No, of course not.
It's more about learning to read the clues, the footprints they leave behind in the market's behavior, especially using technical analysis tools.
Okay, got it. So the article starts with something called Wyckoff theory. Now, this isn't new, is it? Sounds like it's been around.
Oh, yeah, it's got history. Richard D. Wyckoff came up with this framework way back, early 20th century.
Wow.
But it's still super relevant today. He basically saw the market moving in these, predictable cycles, all driven by supply and demand.
Okay, basic economics.
Right. But here's the twist. Wyckoff believed these cycles were largely driven by the deliberate actions of those big institutional players we're talking about, the smart money, as some call them.
Right. So what are the key phases in these cycles? What do we need to look out for?
Well, Wyckoff's main focus is on two primary phases: accumulation and distribution.
Okay, accumulation.
Accumulation is when these big players start quietly buying up shares, building their positions. Think of them like strategic bargain hunters.
Ah.
They're buying significant amounts, often when the price is flat, or even kind of drifting down when maybe the general mood is pessimistic.
Buying when others are hesitant or selling? Sneaky.
Sort of, yeah, like buying winter coats in July when they're cheap, because demand will pick up later.
Okay, makes sense. So that's accumulation. Then the opposite must be distribution.
Exactly. Distribution is when those same institutions start selling off their holdings, unloading the shares they accumulated.
And when does that usually happen?
Often during periods of, general market optimism, when prices look high and maybe the average investor is feeling pretty bullish.
So they sell into the strength that they helped create.
That's the idea. They capitalize on that increased demand to sell their large positions, hopefully at a nice profit.
The article also mentioned markup and markdown phases. Briefly, where do they fit?
Right. So markup is the upward price trend that naturally tends to follow successful accumulation. Demand starts to outstrip supply.
Okay.
And markdown is the opposite. It's the downward trend that usually follows distribution as all that institutional selling starts to weigh on the price.
Gotcha. So Wyckoff's core idea was figure out which phase we're in, see what the big guys are likely doing, and try to align with that.
Precisely. Align your strategy with the likely actions of these big fellows, as Wyckoff called them. That was his key insight for improving your odds.
Okay, cool concept, but how do you see this happening? How do you spot accumulation or distribution on a chart? The article brings up the bulls and bears system.
Yeah, the bulls and bears system. It's designed to be really visual, actually, to give you a clear picture of the trend and, importantly, highlight these potential zones.
Visual how? Like colors.
Exactly. It color codes the price bars on your chart. Green bars mean a bullish trend. Buyers are generally in control, price moving up.
Okay, green is good for bulls. Makes sense.
Red bars mean a bearish trend. Sellers have the upper hand, price is heading down.
Right.
And then you get yellow, or sometimes called neutral bars. These suggest things are transitional, consolidation. The market's pausing, maybe deciding its next move.
A warning signal, maybe? Or just a pause?
Could be either. It's a time to be alert, definitely.
So how do these colors help us see what the institutions might be up to with the accumulation and distribution?
Okay, here's where it gets interesting. Those accumulation zones where institutions are likely buying quietly, they often show up on the bulls and bears system as a mix of, say, yellow and green bars.
Yellow and green, why that mix?
Well, the yellow suggests that sideways movement, right? No strong trend yet, which is often when they like to buy without pushing the price up too much.
Oh, okay.
And the occasional green bar mixed in might hint at that underlying buying pressure starting to build.
I see. And distribution zones.
Typically, you'd look for a combination of yellow and red bars. Again, the yellow might signal that topping process, the indecision, followed by red bars as the selling pressure starts to really take hold and push the price down.
So it's like a visual clue machine, highlighting these potential hot zones for institutional activity.
That's a good way to put it. An early warning system, perhaps?
Okay. Now, the article adds another layer, the Chaikin Money Flow, or CMF. Sounds a bit more technical.
It is, yeah. The calculation's a bit more involved, but its purpose is really, really important. The CMF tries to measure the intensity of buying and selling pressure.
Intensity. How?
It looks at both price and volume over a set period. So it's not just asking which way is the price going, but also how much conviction, how much volume is behind that move.
Okay, like gauging the strength of the wind, not just its direction.
Exactly. That's a perfect analogy.
So how do we actually read the CMF? What do the numbers mean?
It oscillates around a zero line. Pretty simple, actually. When the CMF is above zero, it generally suggests net buying pressure, potential accumulation.
Above zero, buying. Got it.
When it's below zero, that points towards net selling pressure, potential distribution.
Below zero, selling. Does it matter how far from zero it is?
Yes, definitely. The further away from zero, the stronger the implied buying or selling pressure is. A CMF way up in positive territory suggests stronger buying than one just barely above zero.
Right. Now, you hinted earlier, or the article did, about the colors sometimes being weird, counterintuitive.
Ah, yes. This is a crucial point. On some charting platforms, the way CMF is colored can seem backwards if you're thinking purely about price direction.
How so?
Well, normally we think green for up, red for down, right? But with CMF, specifically looking for institutional footprints, you might see red bars above the zero line.
Right above zero. But above zero means buying pressure.
Exactly. But think about it. If institutions are distributing, selling large amounts, they often do it while the price is still relatively high, or even rising slightly, selling into strength.
Ah, so the CMF is positive. Buying pressure appears dominant overall. But the color signals that institutions might actually be the ones selling into that demand.
Precisely. It's tailored to spot their likely behavior. Conversely, you might see green bars below the zero line.
Green below zero, so net selling pressure overall.
But the green suggests institutions might be the ones doing the buying, accumulating shares while the price is weak, or going down, being contrarian.
Okay, that twists my brain a little, but I think I get it. It's about their specific, often subtle strategies, not just simple price up down.
You've got it. It's about trying to see where the smart money is actually flowing, even if it seems contradictory at first glance.
So how do these two tools, bulls and bears and CMF, really work together? The article stresses using them in combination.
Yes, that's absolutely key. They offer complementary views. Bulls and bears gives you that visual trend identification, those potential zones based on price action.
Right, the colors.
And the CMF then comes in as a confirmation tool. It gives you a quantitative measure of the volume, the buying or selling pressure behind those price moves.
Okay, can you walk me through an example how they might align.
Sure. Let's say you see a nice series of green bars on the bulls and bears chart. Suggests an uptrend, right?
Yep.
If at the same time you look at the CMF and see it's positive above zero and maybe even trending upwards itself.
That gives you more confidence.
Exactly. It adds confidence that there's real buying volume supporting that price rise. It's not just, noise.
And the flip side, red bars on bulls and bears.
And if the CMF is negative, below zero, and perhaps falling, that strengthens the case for real selling pressure, confirms the bearish trend signal from bulls and bears.
What about those yellow neutral bars on bulls and bears? When the trend isn't clear, how does CMF help then?
This is where CMF can be super insightful. During those consolidation periods, the yellow bars, CMF can give you clues about what's happening under the surface.
Right.
Well, if you see yellow bars, but the CMF indicator is actually starting to creep up, maybe crossing above zero, that could suggest that even though the price isn't making big moves yet, institutions might be starting to accumulate, quietly buying during the pause, hinting at a potential bullish move to come.
And if the CMF is falling during those yellow bars?
Then it might hint at the opposite. Underlying distribution, selling pressure building up, potentially setting the stage for a move lower.
Okay, so CMF is like the volume verification step. Does the volume support what the price action via bulls and bears seems to be suggesting about the big players?
Precisely. It helps you look for confirmation, both indicators saying the same thing. That's usually a higher probability signal.
Does it help with anything else?
Yes, it can also help you spot divergences.
Divergences.
That's when the price action and the CMF are telling different stories, like maybe the price is making a new high, but the CMF reading is lower than its previous peak.
What would that mean?
It could be an early warning sign that the buying pressure isn't as strong as the price suggests. The conviction behind the move might be weakening. It doesn't guarantee a reversal, but it's something to watch closely.
Got it. Confirmation, divergence detection, gauging trend strength. Useful combo. Now, the article wraps up with something called the 1-2-3 knockout punch strategy. So it's pretty action-packed.
Hey, yeah, it's a catchy name. It basically takes the bulls and bears and CMF combination and adds one more indicator to the mix.
A third one. Which one?
The Williams Accumulation Distribution Indicator, often just called Williams AD.
Okay, another AD tool. What does this one do differently?
It's also a momentum tool, looking at buying and selling pressure. But it focuses specifically on where the price closes within its daily range. It can be particularly good at spotting potential reversals or confirming trend strength.
So, 3 indicators working together. The article used a boxing analogy. Bulls and bears was the uppercut.
Yeah, that's the playful analogy they use. Bulls and bears is the uppercut because it spots the primary trend, the main direction. It's your opening shot.
Okay. And CMF was the cross.
Right. CMF is the cross, the confirming blow. It validates that trend identified by bulls and bears by showing you the volume, the power behind it.
Uppercut sets the direction, cross confirms the power. What's the Williams AD? The jab.
Exactly. The Williams AD is the jab. It's a bit more nuanced. You use it to probe for weaknesses in the trend, look for those divergences we talked about.
How so?
For instance, like we said, if the price is hitting new highs, but the Williams AD line isn't making new highs,
Right.
That's a bearish divergence, a potential warning jab that the uptrend might be running out of steam.
So it's like a final check for hidden weaknesses or potential turns.
Kind of, yeah, or confirming strength if it is moving in line with price. The idea of the 1-2-3 punch is that using all 3 together gives you a more holistic view.
Trend, volume confirmation, and potential reversal signals. Trying to cover more bases.
That's the goal. Filtering out false signals you might get from just one indicator and hopefully making more informed, higher confidence decisions.
Okay, so let's tie this all together then. The big message from this deep dive, drawing on that article, is that understanding what the big institutional players are doing, that can really be a significant edge for us individual traders or observers.
Absolutely. Their sheer size, the amount of money they move, means their activity will leave footprints in the market data. It just has to.
And learning to read those footprints, that's the key.
That's the key. Recognizing the patterns, using tools like walk-off principles, bulls and bears, CMF, maybe even Williams AD. It gives you valuable insight into potential future moves.
But importantly, the article also cautioned against just blindly trying to copy them, right?
Oh, absolutely. Critical point. Understanding their strategies is huge, yes. But it's only one piece of the puzzle. The market is incredibly complex. You've got fundamentals, news events, economic data, just general sentiment, all playing a role. Mimicking is not enough.
So you need a well-rounded approach. technicals, like we discussed, but also understanding the bigger picture.
Exactly. A holistic view is crucial. Think of understanding institutional flow as a powerful lens, but not the only lens you should use.
So the real takeaway isn't trying to be a whale, but learning to, I guess, read the water, understand the currents they create.
That's a great way to put it. Learn their language, understand their likely moves, so you can navigate those financial waters with more awareness, more confidence.
Instead of just reacting to the waves, maybe starting to anticipate the shifts driven by those deeper currents.
Precisely. Moving from reactive to potentially more proactive, or at least more informed, in your market analysis or trading.
Well, this has been genuinely fascinating. A real deep dive into decoding that institutional secret language. Thanks for breaking it down.
My pleasure. It's a complex topic, but hopefully those tools offer a practical starting point.
Definitely.